You've probably heard someone say, just invest in index funds, like it's the easiest thing in the world. But then you open your 401k at work and see words like ETF, mutual fund, target date fund, and suddenly you're paralyzed because you don't want to mess up the little money you're finally putting away. Look, I get it. When you're trying to stretch a paycheck between rent, groceries, and maybe building a small emergency fund, the last thing you need is confusing investment jargon that makes you feel like you need a finance degree just to save for retirement. Here's what we're doing today. I'm going to break down ETFs, index funds, mutual funds, and hedge funds in plain English, what they actually are, how they're different, and most importantly, which ones you'll actually encounter when you're trying to invest through your job or on your own. By the end, you'll know exactly what you're looking at when you open that investment account, and you'll feel confident picking something that makes sense for your situation. With inflation eating into every dollar, and a lot of people realizing Social Security probably won't be enough, more Americans are being told to invest early. But here's the problem. Most of us were never taught how. And when the options all sound the same, it's easy to do nothing. That's costly. So, let's fix that. A fund is just a basket of investments. Instead of buying one single stock, like just Apple or just Tesla, you're buying a little piece of hundreds of different companies all at once. That's called diversification, and it's basically the financial version of not putting all your eggs in one basket. The reason funds matter is simple. If you only own one stock and that company tanks, you lose everything. But if you own a fund with 500 companies in it and one tanks, you barely feel it. That's the whole point. Now, there are different types of funds, and that's where people get lost. The terms ETF, index fund, and mutual fund get thrown around like they're totally separate things. They're not. They overlap. An index fund can be an ETF. A mutual fund can be an index fund. It's confusing because the categories aren't clean. So let me clarify. An index fund isn't a specific product, it's a strategy. It just means the fund is designed to copy a specific market index, like the S&P 500. The S&P 500 is a list of the 500 biggest U.S. companies. When you invest in an S&P 500 index fund, you're basically saying, I want to own a tiny slice of all 500 of those companies. The fund automatically matches whatever those 500 companies are doing. If the market goes up 10%, your fund goes up 10%. If it drops, you drop with it. The reason index funds became so popular is because they're passive. No one's in there picking stocks or trying to beat the market. The fund just follows the index. And that keeps costs low, which matters more than you think, because fees eat into your returns over time. So here's the key. Index fund describes the strategy, tracking an index. It doesn't tell you how the fund is structured. That's where ETFs and mutual funds come in. A mutual fund is a type of fund structure. When you buy into a mutual fund, you're pooling your money with a bunch of other investors, and a fund manager uses that pool to buy stocks, bonds, or other assets. Here's how it works. Mutual funds are priced once a day at the end of the trading day. So if you decide to buy or sell shares, your transaction doesn't happen in real time. It happens at that end-of-day price. Mutual funds can be actively managed or passively managed. Actively managed means there's a team of people picking stocks, trying to beat the market. These usually have higher fees because you're paying for that human expertise. Passively managed means the fund is just tracking an index, like an S&P 500 index fund. Lower fees, less guesswork. Most 401k plans offer mutual funds, and a lot of them are index mutual funds, which is great. You're getting diversification and low fees in one package. ETFs stands for Exchange Traded Fund. It's also a fund structure, but it works differently than a mutual fund. ETFs trade on the stock market throughout the day, just like a stock. That means the price changes constantly, and you can buy or sell whenever the market's open. Mutual funds? You're stuck waiting until the end of the day. Most ETFs are index funds. They track an index like the S&P 500 or the total stock market. But some are actively managed, just like mutual funds. The big difference people care about, ETFs usually have lower expense ratios than mutual funds. We're talking 0.03% versus 0.15% or higher. Over 30 years, that adds up to real money. So why doesn't everyone just use ETFs? Because a lot of employer 401k plans don't offer them. They offer mutual funds. And that's fine. If it's a low-cost index mutual fund, you're still in good shape. People get stuck thinking one is better than the other. But honestly, if you're comparing a low-cost S&P 500 index mutual fund to a low-cost S&P 500 ETF, the difference is tiny. What matters way more is that you're actually investing, you're diversified, and you're not paying high fees. The real problem starts when people pay attention to the wrong thing, like obsessing over ETF versus mutual fund, and ignore the fees or the fact that they're in some random actively managed fund that's charging 1% a year and underperforming the market. Okay, now hedge funds. You've probably heard the term, especially in movies or the news. Here's the truth. Unless you're worth millions, you're never going to invest in one, and that's not a bad thing. Hedge funds are private investment funds for wealthy people and institutions. We're talking minimum investments of $100,000, often way more. They're actively managed, and they use complex strategies, short selling, leverage, derivatives, to try to make money in any market condition. The pitch is that hedge funds can make you rich even when the stock market's crashing. The reality, they charge insane fees, usually 2% of your assets per year, plus 20% of any profits. And a lot of them don't even beat the S&P 500 after fees. You don't need to worry about hedge funds. They're not designed for regular people building wealth. They're designed for people who already have wealth and are looking for alternative strategies. For someone trying to save for retirement on a middle-class income, they're completely irrelevant. So here's the bottom line. Index funds are a strategy, tracking a market index like the S&P 500. ETFs and mutual funds are structures, ways that strategy gets packaged. Most of the time, you'll be choosing between index mutual funds in your 401k or ETFs if you're investing on your own through an app like Fidelity or Vanguard. Both work. What matters is that the fees are low, ideally under 0.2%, and that you're actually contributing consistently. Hedge funds, forget about them. They're not for you, and they don't need to be. If you're opening a 401k or an IRA and you see options like S&P 500 Index Fund or Total Stock Market Index Fund, and the expense ratio is low, you're on the right track. You don't need anything fancy. You just need to start. Real security comes from understanding the rules, even when they're stacked against you. If this cleared things up, hit subscribe. We're cutting through the noise every week so you can make smarter decisions with your money. See you in the next one.